Hey, welcome back. Let me ask you something important. Have you ever bought Bitcoin or any crypto near the top of a massive rally, watched it drop 60 or 70% over the following months, and wondered what you did wrong? Or have you ever sold your crypto during a brutal bear market just before it started one of the biggest recoveries in its history? If either of those experiences sounds familiar, you're not alone. These are the two most common and most expensive mistakes that crypto investors make, and both of them happen for the same reason. They did not understand the market cycle. Bitcoin does not move randomly. It never has. Since its very beginning, Bitcoin has moved through a remarkably consistent pattern of cycles. Periods of accumulation, followed by explosive growth, followed by dramatic decline, followed by recovery, and then the whole pattern repeating again. Understanding this cycle does not give you a perfect crystal ball. No tool in investing does that, but it gives you something incredibly valuable. It gives you context. It tells you roughly where you are in the bigger picture. And that context changes every investment decision you make for the better. By the end of this video, you will understand the four phases of the Bitcoin market cycle, what drives each phase, how to identify which phase we are currently in, and how to use this knowledge to make smarter decisions with your money at every stage. Let us get into it. Why Bitcoin moves in cycles? Before we break down the four phases, let us understand why Bitcoin moves in cycles at all. The answer lies in a combination of human psychology, supply mechanics, and institutional behavior all interacting together. The most important mechanical driver of Bitcoin cycles is the halving event. Every 4 years, approximately, the number of new Bitcoin produced per block is cut in half. This is programmed directly into Bitcoin's code and has happened consistently since Bitcoin's creation. The halving reduces the rate at which new Bitcoin enters circulation. Basic economics tells us that when supply growth slows and demand stays the same or increases, prices tend to rise. The halving creates a predictable supply reduction that has historically preceded each of Bitcoin's major bull markets. But the halving alone does not explain the full cycle. Human psychology amplifies it dramatically. When prices start rising after a halving, media attention increases. New investors enter the market. Their buying pushes prices higher. More media attention follows. More buyers enter. Fear of missing out spreads widely. The cycle feeds itself until prices reach levels where early investors begin selling their substantial gains. Then, when prices fall, the process reverses. Fear replaces excitement. Sellers outnumber buyers. Media coverage turns negative. Weak holders panic and sell. Prices fall further. The negativity feeds itself until prices reach levels that attract value buyers who see long-term opportunity. And then the cycle begins again. This interplay between the mechanical supply reduction of the halving and the psychological amplification of human emotion creates one of the most consistent cyclical patterns in the history of financial markets. Understanding this dynamic is the foundation of everything else we are going to cover. Phase 1. Accumulation. Phase 1 of the Bitcoin market cycle is called accumulation, and it is the phase that creates the most wealth for the investors who recognize it while it is happening. Accumulation occurs after a prolonged bear market when prices have fallen significantly from their previous peak. The news about Bitcoin is predominantly negative. Mainstream media is writing obituaries for crypto. Social media sentiment is at its lowest. Many retail investors who bought near the previous top have sold at a loss and sworn off crypto forever. But quietly, patiently, and systematically, sophisticated investors are buying. These are the investors who understand the cycle. They have seen this phase before. They know that maximum pessimism in financial markets almost always coincides with maximum value opportunity. During accumulation, price action is choppy and slow. There are no exciting rallies, no dramatic headlines. The market feels dead, and that lack of excitement is precisely what allows informed investors to accumulate large positions at low prices without the competition of a crowd trying to do the same thing. How to identify the accumulation phase? Prices have fallen significantly from the previous peak, typically 60 to 80% or more. Market sentiment is broadly negative. Search interest and social media discussion about Bitcoin is at a multi-year low. On-chain data shows long-term holders are accumulating rather than selling, and the time since the last halving suggests the next one is approaching within the next 1 to 2 years. The accumulation phase is uncomfortable to invest during. Everything feels wrong about it, and that discomfort is exactly why most retail investors miss it entirely. Phase 2, the bull market. Phase 2 is what everyone in crypto talks about, the bull market. The bull market begins quietly after the accumulation phase. The halving occurs or is approaching. The reduced supply of new Bitcoin combined with steady or growing demand begins pushing prices upward. Early in the bull market, price increases are gradual and largely ignored by mainstream media. The investors who accumulated during the previous phase are watching their positions grow, but the general public is not yet paying attention. Then a threshold is crossed. Prices reach a level that triggers widespread media coverage. Bitcoin is back in the news. Social media excitement builds. People who have never owned crypto begin asking how to buy it. This influx of new retail investors accelerates the price increase dramatically. FOMO spreads widely. Every new price high generates more media coverage, which brings more buyers, which creates new price highs. Institutional investors who had been watching from the sidelines begin deploying capital at scale. Their large purchases add significant buying pressure. The combination of retail FOMO and institutional accumulation creates a powerful upward move. During peak bull market conditions, price targets that seemed absurd earlier in the cycle begin to seem not just possible but inevitable. Projections of extraordinary price levels become mainstream conversations. This is the phase that most new investors enter crypto. Attracted by the media coverage, the social excitement, and the fear of missing out on extraordinary gains. And this timing, entering during the excitement phase rather than the accumulation phase, is the root cause of most retail crypto investment pain. The bull market eventually exhausts itself. Early investors who accumulated during the bear market begin taking profits at scale. Selling pressure increases, price momentum slows, and the transition to the next phase begins. Phase 3, the distribution. Phase 3 is the distribution phase, and it is the most deceptive phase in the entire cycle. Distribution is when sophisticated investors who accumulated during the bear market and held through the bull market begin systematically selling their positions to the retail investors who are still buying based on peak cycle excitement. The price does not immediately collapse during distribution. In fact, the market often continues making new highs during early distribution. This is what makes it so dangerous. The experienced investors selling their positions do so gradually to avoid crashing the price before they have exited. They sell into the continued buying pressure from retail investors who are most excited and most aggressive in their buying near the top of the cycle. The signals of the distribution phase are subtle but identifiable. Price gains become smaller and slower despite positive news continuing. Each new high is met with stronger selling. Volatility increases significantly with sharp, sudden drops followed by partial recoveries. Long-term holders on chain are showing decreasing wallet balances, and valuations reach levels that are extremely difficult to justify even with optimistic future projections. Most retail investors do not recognize the distribution phase while it is happening. The news is still positive. The community is still excited. Influencers are still calling for higher prices. But the money that drove the bull market is quietly leaving. By the time most retail investors realize the distribution phase has occurred, the transition to the next phase is already well underway, and the most significant losses have already happened. Phase 4, the bear market. Phase 4 is the bear market, and while it is the phase most investors fear, understanding it completely changes how you experience it. The bear market begins when selling pressure from distribution overwhelms incoming buying. Prices begin falling consistently. Initial drops are often dismissed as healthy corrections within an ongoing bull market. Many retail investors buy the dips expecting a recovery, but the recovery does not come, or if it does, it is partial and followed by further declines. The pattern of lower highs and lower lows establishes itself clearly on the chart. As prices fall further, media coverage turns negative. Stories about Bitcoin dying appear regularly. Investors who bought near the top are now holding substantial losses. Some sell to stop the pain, adding more downward pressure. The bear market is psychologically brutal. It tests conviction in ways the bull market never does. Investors who were confident and excited at the top become uncertain and fearful at the bottom. But here is the perspective that changes everything. Every Bitcoin bear market in history has been followed by a new bull market that exceeded the previous peak. Every single one. The bear market is not the end of Bitcoin. It is the reset that creates the conditions for the next accumulation phase. The bear market creates the exact conditions we described in phase 1. Low prices, negative sentiment, retail investors leaving the space, and patient, sophisticated investors beginning to quietly accumulate again. The cycle continues. Let me bring everything together into a clear and actionable framework. Bitcoin moves through 4 consistent phases driven by the interplay of supply mechanics, the halving, and human psychology. Phase 1 is accumulation. Prices are low, sentiment is negative, smart money is buying quietly. This is the best time to build positions and the most uncomfortable time to do so. Phase 2 is the bull market. Prices rise dramatically, media attention grows, retail FOMO peaks. This is when positions built during accumulation generate extraordinary returns. It is also when the most dangerous investment decisions are made by those entering late. Phase 3 is distribution. Sophisticated investors are quietly selling into continued retail buying. Price action becomes choppy, gains slow. This is the most deceptive phase and the hardest to recognize in real time. Phase 4 is the bear market. Prices fall significantly from the peak. Sentiment is broadly negative. Most retail investors sell at a loss, and the conditions for the next accumulation phase are being created. Here is the practical wisdom that this framework gives you. When everyone around you is euphoric and prices seem to go up every day, that is when to be most cautious. Reduce exposure, take profits, prepare for the distribution and bear phases that always follow. When everyone around you is despairing and Bitcoin seems like it will never recover, that is when to be most interested. Research, accumulate gradually, build the positions that the next bull market will reward. The cycle does not repeat with perfect precision. Timing is never exact. The specific peaks and bottoms cannot be predicted with certainty, but the broad pattern has been remarkably consistent throughout Bitcoin's entire history. Investors who understand this pattern make decisions from a position of knowledge rather than emotion. They are not surprised by bear markets. They are not caught up in bull market euphoria. They understand that every phase of the cycle is temporary and that each phase creates specific opportunities for those who recognize it. That understanding is worth more than any single trade, any single indicator, or any single price prediction. If this video gave you a clear understanding of Bitcoin market cycles, please hit the like button and subscribe. This is the kind of foundational knowledge that changes how you think about crypto investing permanently. Drop a comment below and tell me this. Based on what you learned today, which phase of the Bitcoin cycle do you think we are currently in? I read every comment and I want to hear your thinking. I will see you in the next one.